It's time to learn the trading entry models. The first one we are going to cover is the supply and demand. Supply and demand zones are price levels or areas where smart money are most actively trading, with the largest volume. So that helps us identify these levels and follow the smart money footsteps. If you look at any financial market, be it stocks, crypto, forex, we should know that the markets move in certain cycles. They go from balance to imbalance, and the then market moves from imbalance towards balance. In other words, the market always chases efficiency, fair pricing, and a fair chance for both buyers and sellers to enter a market. A balanced price looks like this. It moves like a consolidated or ranging market. It essentially shows that buyers had the same strength as the sellers. Therefore, the market creates a choppy price action. The balance must be broken. It's how the nature of the markets is. And this break of balance is called an imbalance. An imbalance in the market is created once the market is pushed aggressively out of balance. This movement is often made by smart money and large institutions with very, very large amounts of money. Remember what we have said before. The market moves towards balance. We can apply this information because from this imbalance, the market will eventually try to rebalance itself. And the rebalance is indicated by two zones that we will talk about. These zones are called supply and demand zones. Let's start with to explain what is the supply. The supply zone is met within two types of price action. One type is the reversal supply zone. This zone is characterized by price going up, creating a ranging movement sideways, and going all the way back down. This whole price action is also often named as a rally, base, drop. The second type of supply is the continuation supply zone. This zone is defined by price action that drops significantly to the downside, then started a slow downtrend and breaks to the downside again. This whole price action is named a drop, base, drop. Now for the demand. We also have two types of price action within the demand zones. One type is the reversal. The reversal is seen by price going down, creating a consolidation or ranging market. Then the price breaks all the way upside. This movement is named as a drop, base, rally. Then the second type of demand is the continuation. The continuation is seen by a significant upside movement, then a slow upside movement, and another significant upside movement. This market movement is named a rally, base, rally. So you should be able to notice how the market is balanced. Then it breaks the balance and becomes an imbalanced or inefficient market. And the market looks to rebalance itself. As we have said before, the balance is when price is moving fair towards both directions. So in simpler terms, once a market is ranging, and an imbalance market is when the price does not give fair chances to one party, either the buyers or the sellers. Now that we know what demand and supply are, we need to know how to identify them, and how can they be used by traders. The supply is a zone where the market has been balanced, and it suddenly broke the balance to the downside. So this zone is the supply zone. So knowing this sharp move has imbalanced the market, as we have said multiple times before, the market moves towards balance, and we wait for it to happen. This translates to waiting for the price to come back up into the supply zone. This gives traders a sell short opportunity, but under certain conditions that we will soon learn them. Now for the demand zone, it is essentially the opposite way around. The market has been balanced, then breaks the balance by price going to the upside in a very aggressive way. The zone where price has moved before the break is the demand zone. Now that the market is imbalanced, it wants to move towards balance. That translates into price moving back down to the demand zone. This gives traders a buying opportunity. We will soon see how to filter the moves in such a way we can identify high-quality zones. But for now, let's present how to identify the supply and demand zones using candlesticks. Finding and using these supply and demand zones is relatively simple, and it is done by following some steps. The first step is to look for a candle or a small series of candles with large volume that breaks the balance by pushing the price aggressively either to the upside or to the downside. In this certain scenario, this move is to the downside. Now that we have identified that candle, we move into the second step, which is to observe the candle previous to the candle that broke the balance. So to make sure we understand, we are talking about the last candle before the price has moved aggressively. So that is this candle. Now that we also identified the candle, we move into the third step, which is to take the high and low of that candle, so the high and low of the candle from the second step, and draw a zone to the right. You can do that by using lines, but the most common it is marked by a rectangle or box. And this rectangle zone is the supply zone. The supply zone is used if eventually price comes back up to rebalance the market. The price has a high probability of rejecting to the downside from the zone, and this gives traders an opportunity to snipe sell short positions. Now for the demand zone. The first step is to find an aggressive move towards to the upside, a move that breaks the market's balance. The second step is to identify the candle before the aggressive move. The third step is to mark the high and low of that candle, and we wait for the market to rebalance, by price eventually going down, and rejecting the zone to the upside, giving traders a setup for a buying opportunity.